and to debate and discuss all of the data that is out there. So we really, really appreciate everyone joining the conference. I know it can be challenging to set aside the demands of incoming emails when attending a conference in person. And we know that this is likely to be even more challenging when working from home and balancing life and work from the same space. We've worked hard to create a conference that is compelling enough that you will want to set aside time and attend as many sessions as possible. And we invite you to engage with our speakers, visit our exhibitors' booths, and network with friends and colleagues. One of the pieces of feedback that we receive year after year is there is not enough time for networking. And getting that balance right is even more challenging in a virtual environment. The NABE staff interviewed lots of vendors and chose a terrific conference platform. We've scheduled in long breaks in the middle of the day so that you can decide whether to get some work done, check in on things at home, or engage in the optional small group discussions and sector meetups. Today, we will have a small group discussions based on topic, and tomorrow we will have sector meetups. Now, these events have limited attendance and are designed to encourage conversation and networking. So if you've not already signed up, please do so. One housekeeping note, tomorrow's meetups will be sector focused, and you can click on the sector meetups to reserve your spots for these virtual meetings within Pathable. The planning for NABE's annual meeting actually begins 12 months in advance. This time last year, we were already crafting a spectacular meeting in Chicago. And having a pandemic hit midstream in the planning process may seem insurmountable, but not to our intrepid and committed conference chairs. I would like to thank our chairs, Julia Coronado, Lisa Emsmo-Mattingly, Jed Kolko, and Frank Nothaft, for rolling with the punches. Now, if we were live and in person, we'd ask them to stand and we'd all give them a round of applause. And I might even mention that at the urging of Jed Kolko, we decided to make this year's conference business casual. So I'm sure that we probably have succeeded at that, since most of you are tuning in from home, and while you may have your Zoom blouse on top, maybe you have jeans or yoga pants or sweatpants on the bottom. When we resume our in-person meetings, we won't be quite this casual, but we do hope to start a trend towards business casual at the majority of NABE meetings. Now, our chairs were joined and greatly assisted by the excellent conference committee, the NABE roundtable chairs, who planned many of the sessions, and the NABE staff, who tore up the conference playbook and started from scratch once the pandemic took hold. Sadly, our Chicago in-person meeting will have to wait a couple of years, unless of course you live there. And for our Chicago members, we are looking forward to being on your home turf in due time. We also have to thank all of our sponsors, in particular, the Peterson Foundation, Fidelity, KPMG, the McKinsey Global Institute, FedEx, Haver Analytics, IHS Markit, Morgan Stanley, Remy, Ford Credit, Grant Thornton, Morning Consult, NFIB, and the Upjohn Institute. Without the support of our sponsors, this event would not be possible. And please do visit the virtual exhibit booths during the midday breaks. Each of our 5 exhibitors has scheduled demos and talks from their experts, and you can click on the booths to check the schedule of activities each day. Now we will proceed with the conference program. I will pass the baton to Diane Swonk of Grant Thornton to moderate our first session with Chicago Fed President Charlie Evans.
Thanks, Constance. And here, cheers to you with my NABE mug. I really appreciate it. And it's my honor to be able to welcome you from Chicago with Charlie. We are in Chicago of sorts. I wish I could have welcomed you here. And the last time I was able to see all of you. It was in late February during the policy conference, and many of you I've seen on many of NABE sites on what we've been doing. It's just been a phenomenal resource, as Constance pointed out, the need to be able to see each other, to talk to each other, to share information, and to share our collective intelligence, or lack thereof at times when we try to figure all this out, but it's been challenging, and I really appreciate all of you and all your support. So it's my honor today to be able to moderate this session with Charlie Evans, who's going to give us a few comments first. But let me just give you a little bit of background on Charlie. I've known Charlie for quite a while, and I just can't say enough good things about him. And he has a terrific wife who is a wonderful chef who's also going to be monitoring. I always do this to Charlie. He hates it when I do it, but she's, you can call up and get advice on your turkey for Thanksgiving. Apparently starting with Canada's Thanksgiving, she's already ramping up to make sure you cook your turkey accurately and you do not get yourself food poisoning on top of everything else. But Charlie is an amazing guy. I have known him for a long time, back before he became Fed chair, president of the Chicago Fed in 2007, which was just as the first inklings of the financial crisis was really breaking, the subprime financial crisis back in 2007. And I remember actually emailing him on midnight when he became Fed president, congratulating him and also offering him my condolences, because I was happy for us that we had Charlie on board, given his extraordinary research and his knowledge and his ability to guide the Fed at a difficult time. I think these times are even more difficult for the Federal Reserve, and we're really lucky to have Charlie going from the director of economics of research at the Chicago Fed into the presidency role. He's also involved in so many things in Chicago. He's on the board of Rush University's healthcare system, the hospital there. He's on the board of directors of the Economic Club of Chicago, and so many places that I get to see him, and I miss him now, not seeing him in person, but I know you're gonna really enjoy his comments. Well, or at least you'll be sobered and you'll be informed by Charlie's comments, because he's terrific. So take it away, Charlie. Thank you.
Oh, thank you, Diane. That's very kind. And I'm very sorry that we can't all get together in one room in Chicago and have a tremendous gathering. I'm sure we will do it before too long. And thanks to the organizers for inviting me to offer my views on the economy and monetary policy. It's a real honor to be the kickoff speaker at this year's NABE annual meeting. And before I get started, let me just provide the usual disclaimer that these are my own views and not necessarily those of anyone else in the Federal Reserve System or on the Federal Open Market Committee. Well, as 2020 opened, the fundamentals for the US economy were solid, with unemployment at 3.5% and strong consumer spending. Then the COVID-19 virus hit and activity plummeted as we and much of the rest of the world locked down in order to fight the pandemic. Today, the economy is forging its way back in spite of virus flare-ups and a horrific death toll of over 200,000 in the United States. The US economy has a long way to go. The unemployment rate is just under 8%. About 12.5 million people are unemployed, and inflation continues to be well below our 2% goal. Monetary policy has an important role to play in these unusual and uncertain times. And the Federal Reserve is prepared to use its full range of tools in order to support the US economy's attainment of maximum employment and inflation that averages 2% over time. A key element of this support will be the effective execution of the FOMC's new long-run monetary policy framework that Chair Powell announced in August. This is articulated in the committee's revised consensus statement on longer-run goals and monetary policy strategy. The recent September FOMC statement followed through on the new strategic principles, in part by providing strong, outcome-based forward guidance about the future path for interest rates. These commitments reaffirm the Federal Reserve's resolve to provide the monetary accommodation needed to achieve our policy goals in as timely a fashion as possible. Today, I would like to discuss some of my views on the messages in our new long-run framework and the September policy statement. I also will explore how the new consensus statement might have affected what some commentators have described as the Fed's mistaken decisions to raise rates as soon and as high as we did over the 2015 to 2018 rate cycle. And I hope to be more informative on alternative policy considerations than simply defensive. But I'll let the listener be the judge. Let me start with a few comments about the new long-run strategy statement. And today's assembled group of experts is familiar with the revised statement, so I'll just emphasize a couple of points. To me, the biggest impetus for updating our monetary policy strategy was the undeniable realization that the effective lower bound on the federal funds rate was not just an anomaly that we stumbled into during the great financial crisis. The ELB is a persistent threat to the achievement of our dual mandate goals. The research here is clear. For well-known structural reasons, the long-run equilibrium real Fed funds rate is much lower now than it was in the 1980s and 90s. This means even average business cycle shocks will drive the funds rate to its lower bound. And the kind of shock we received in March was far from average. Research also shows that under traditional monetary policy strategies, the proximity of the effective lower bound will impart a downward bias to inflation and inflation expectations relative to our 2% target. And this bias is always present. It's not just an occasional risk associated with a large negative shock. The ELB will also impede the achievement of our maximum employment mandate. These facts imply a couple of things. First, a systematic adjustment to monetary policy strategy is needed to offset the bias. Second, at times, this bias adjustment will require generating inflation above 2% in order to center inflation and inflation expectations at target. I'm happy to say that the new monetary policy strategy delivers on these two fundamental principles with its flexible inflation averaging goal and explicit recognition that policy will need to purposely aim for inflation rates higher than 2% at times. The new framework also emphasizes that our maximum employment mandate is a broad-based and inclusive goal, and that monetary policy will seek to eliminate shortfalls from maximum employment. Shortfalls was an important refinement. Our Fed Listens events were full of discussions with community leaders and others who emphasized the benefits of a strong job market. I could tell many stories from those conferences, but I'm short on time for that. Maximum employment means bringing as many people as possible into the labor force and finding them productive jobs. Furthermore, we are all aware of the great uncertainty surrounding linkages between unemployment and inflation pressures. Recently, inflation was running below target despite a historically low 3.5% unemployment rate. This highlights the challenge for interpreting the influence of lower for longer rates on inflation through a simple Phillips curve mechanism. The new strategy statement does not include specific operational details for how to achieve these goals. I think that is a feature, not a bug. I have long thought that no specific formulaic monetary policy rule will be robust to all of the changes in the economic environment that inevitably will occur. That is, for one reason, I support the statement's flexible approach to average inflation targeting. The strategy statement is instead a commitment to a goals-based policy approach, a philosophy that I've supported throughout my tenure on the FOMC. The precise policy tools and their settings may vary with economic conditions, but the ultimate policy goals remain the same. The new long-run framework envisions that forward guidance will be an important part of the FOMC toolkit. Whenever the FOMC employs forward guidance during a long period of low or zero rates, a natural first question is, what does this mean for when the Fed will first raise rates? This was true in August of 2003, and throughout the 2012 to 15 ELB period, for example. Our September FOMC statement then tackled the question head on. The September statement indicates that we will maintain the current 0 to 0.25% target range until we've reached our employment mandate and inflation has reached 2% and is on track to moderately exceed 2% for some time. This overshooting after a period of sub 2% inflation is straight out of the new long-run strategy. I want to emphasize for some time, as year-over-year inflation readings could be temporarily above 2% next spring as the large drop in prices this year falls out of the annual calculations. The statement also recognizes that our work on inflation might not be complete at the time of liftoff, And so it also indicates that we will maintain accommodative monetary conditions until our inflation averaging goal has been met. This latter criterion is more nuanced, since it relies on comparing the actual funds rate to some concept of a neutral Fed funds rate. Historically, communicating to the public that an upward march in policy rates is still accommodative has often been met with substantial skepticism or outright disbelief. These challenges will be compounded by the fact that short-run R star today likely is depressed below its long-run value, but should move up as the economy recovers. So all in all, I envision much communications work ahead. Still, it can be done. Putting this all together, I view the September 2020 forward guidance as a coherent, multi-pronged policy reaction function, one that should help us deliver on our policy goals. Now, much like buying a new car, when it comes to implementing a new strategy, it makes sense to take it for a test drive. I'd now like to turn to thinking about our new framework and forward guidance through the lens of the recent US effective lower bound experience, specifically the 2015 liftoff and subsequent policy rate increases through 2018. The ultimate success of monetary policy during this period is subject to debate. While we did ultimately experience very strong labor markets, we achieved 2% inflation for only a brief period in 2018, and in the end, that inflation success proved fleeting. Of course, back then our monetary policy framework was focused on deviations of employment from its maximum level, not shortfalls. It also had a symmetric 2% inflation objective with no sense of inflation averaging. Indeed, when former chair Janet Yellen was asked at a recent Brookings conference if the December 2015 funds rate liftoff was a mistake because inflation never overshot 2%, she replied that it wasn't a mistake and that overshooting 2% wasn't the FOMC's objective back then. Still, the inflation experience over this period did not deliver on the old symmetric inflation objective. Furthermore, our struggles over this period influenced my thinking about the new framework a good deal, as I'm sure it did others. So it is worthwhile to reconsider this rate cycle and how it may have evolved differently under our new long-run strategy. Let's review the history. In December 2015, the Fed increased the Fed funds rate for the first time after 8 years at the effective lower bound. At the time, the unemployment rate was about 5%, and the median FOMC participants' projection was for it to be 4.75% over the next 3 years, a couple of tenths below what was generally thought at the time to be its long-run normal level. Core PC inflation was only 1.25% in December 2015, but was projected to move up steadily and reach 2% by 2018. Underlying this forecast, the Summary of Economic Projections median had a 25 basis point rate hike just about every other FOMC meeting for the next 3 years, reaching close to the then assumed 3.5% neutral rate by the end of 2018. So we were looking at a forecast and policy path pretty much fine-tuned to the old framework. Don't push unemployment too low and gradually asymptote in to the 2% inflation rate. Of course, the year 2016 had numerous twists and turns. Heightened uncertainty over growth in China, Brexit, and US politics weighed on the economy, and the FOMC held off on early year policy moves. Still, by the end of 2016, the economy had regained its footing, business sentiment was boosted by expectations of deregulation, tax cuts were on the table and were eventually enacted in late 2017, and equity markets surged. Inflation moved up to 1.75%. Against this backdrop, the FOMC began to raise rates steadily, increasing the funds rate in December 2016 and 3 more times in 2017. The tightening continued through 2018 as labor markets improved, with the unemployment rate falling below 4%. Fiscal policy was massively accommodative, and core PCE ran 2% during much of the year. Any standard monetary policy reaction function had rates returning to neutral and then beyond to avoid further inflation. At the December 2018 FOMC meeting, the target range was raised to 2.25% to 2.5%, close to the 2.75% rate that was the new downwardly revised neutral Fed funds rate setting in the SEP median. Furthermore, the post-meeting policy statement indicated that the committee judged that further gradual increases in the funds rate would be consistent with its policy goals. But no one knew in mid-2018 that US-China trade negotiations and tariff wars would weigh on business sentiment and the economy as much as they did within just a few months. As we moved into 2019, it became apparent that the outlook for growth had become fragile. Furthermore, core inflation dropped sharply to 1.5% early in the year, and only partially recovered before plunging with the pandemic. Monetary policy had to reset, first by changing forward guidance to communicate patience on future rate adjustments, and then by cutting rates 3 times in the second half of the year. So what are some of the lessons that I take from this experience? Lesson number 1, following a prolonged period of underrunning 2% inflation, tightening on an inflation forecast comes with asymmetric risks. Namely, the costs are larger when uncertainties are resolved adversely. During this tightening cycle, the consequences of trade war mischief were not apparent until late in the game. After years of underrunning 2% inflation, the costs of a downside surprise with weaker growth and yet another failure to attain sustained 2% inflation were significantly larger than if the economy had unexpectedly gained momentum. In such situations, having policy give stronger weight to downside risks ex ante seems crucial. The proximity of the ELB comes into play here as well. In our workhorse economic models, it is optimal to run looser policy the closer you are to the ELB because of the limits that the ELB imposes on monetary responses to downside shocks. Lesson number 2. Again, in the context of having underrun 2% for several years, more aggressive monetary policy actions than reflected in the 2015 to 18 dot plots and forward guidance was likely needed to boost inflation sustainably. Those expectations didn't do the trick. Perhaps, as we've just indicated with the September 2024 guidance, the FOMC back in 2016 could have waited until inflation actually got to 2% before beginning to remove accommodation rather than tightening on a forecast. This would have made an inflation overshoot more likely, and indeed ex post, an overshoot probably would have been a desirable outcome. To be sure, some FOMC participants eventually began to advocate for overshooting, but this was not until later in the cycle. Of course, actually pulling this off, whether back then or now, depends on the risk appetite of the committee to overrun 2%. Can tightening wait until we see the whites of inflation's eyes? Or will the committee want to raise rates earlier based on just a strong inflation forecast? The new long-run strategy statement provides the latitude to wait, and our September forward guidance says that we expect to do so. But as inflation approaches 2%, if our policy risk appetite is low, we may have to fight the temptation to raise rates early. I'll have more on this in a minute. Lesson number 3, to end with an old message of mine, in the presence of a low R star and looming effective lower bound, the successful achievement of our inflation goal requires that the FOMC be in it to win it and follow through on averaging 2% inflation over some period of time. Our new long-run strategy definitely gives the FOMC plenty of runway to pursue such a policy effort. So what would have been different in 2015 to 18 under the new framework? Well, from the start, policy would not have been designed to just asymptote into 2% inflation. From the beginning of the Great Recession in December 2007 to the December 2015 FOMC meeting, that's an 8-year period. Core PC inflation averaged about 1.5%. Under the new framework, there would have been a strategic emphasis on producing inflation above 2% for a time in order to offset this shortfall. It's highly likely that this strategy would have forestalled raising rates in 2015 and 2016. Whether inflation would have persistently reached 2% and justified a rate increase sometime in 2017 under this counterfactual is open to debate. Next, there would have been no concern with the unemployment rate falling below the committee's view of its long-run normal level if it wasn't producing undesired inflationary pressures. The committee would have not felt an unemployment-related constraint on pursuing inflation overshooting. And finally, a looser policy would have made the real economy more resilient to the headwinds that hit in 2018 and 2019. It is likely that under the alternative policy, those just at 2% inflation numbers in 2018 would have been turned into a meaningful overshoot, providing a buffer to keep inflation from falling as much below target as it did with the disinflationary shock in 2019. So let's return to today. Under the new framework, we are explicitly trying to average 2% inflation. Some additional perspective likely is useful here. For example, think about how long and how much inflation will need to run above 2% for us to achieve this average. For the sake of argument, here are a couple of simple calculations, just arithmetic. Forget the many years of underrunning 2% since 2008. Let's just start averaging, beginning with the price level in the first quarter of 2020. Core PC inflation in the Summary of Economic Projections is projected to be 1.5% this year and then gradually rise to 2% in 2023. Suppose it hits 2.25% in 2024 and then stays there. In this scenario, cumulative average core inflation starting from the first quarter of 2020 does not reach 2% until mid-2026. That's a long time. If you can produce 2.5% inflation in 2024, you can get there a year earlier. Some, though, might view 2.5% inflation as an excessive overshoot. Now, we're not going to follow a strict numerical formula to determine liftoff or to determine how long to keep policy accommodative after liftoff. Still, these simple calculations illustrate that we likely have a lot of work ahead of us, and it's crucial that we acknowledge the magnitude of the job up front to help lessen the temptation to back off of the overshoot too early in the process. Let me conclude with two observations on how I view the policy situation today, given our new framework and these lessons from history. First, now is not the time to employ a plan to tighten preemptively on the basis of a forecast. Our September forward guidance regarding liftoff rejects this tactic. The guidance is pretty straightforward. Inflation should be at 2% and confidently on track for overshooting before we lift off from the EOB. Now, to some extent, this decision, and certainly the contours of the path after liftoff, may still revolve around the risk appetite of the committee to wait until its goals are clearly in the data, as opposed to being on track for achievement according to a well thought out but still uncertain forecast. Of course, forecasts are always in play. That's in the nature of the game, given the fact that monetary policy works with a lag. But forecasts come with obvious risks, and moving policy on them should be done with careful risk management calculation in mind. Also, we can't allow effective lower bound fatigue to influence our decisions. Simply saying the federal funds rate has been at 0 for a long time is not a good argument for increasing rates. Second, only in Lake Wobegon is everyone above average. In the real world, successful achievement of inflation expectations that are truly reflective of our 2% objective means the FOMC needs to follow through on averaging 2% inflation. This will require actual overshooting, and we can't be timid about doing so. To reduce employment shortfalls and average 2% inflation over time, the FOMC needs to be in it to win it to achieve our 2% inflation objective. Thank you very much.
Thanks, Charlie. Thanks, Charlie. I've got questions coming in for you already, and I appreciate your comments. You've really been a proponent of this average inflation targeting for some time, and I appreciate your perspective you've given us today. I'm going to start out with something you didn't touch on today, but you have touched on in other comments you've made of late, and that is the need for fiscal stimulus. It seems to be fairly widespread throughout the Fed system. What is your feeling about where we are and what we need on fiscal stimulus and what you're willing to talk about on that in terms of, I know you want to stay in your own lane, but where you are relative to what the Fed can do and what you think is needed given the September slowdown in employment?
Well, I think it's a very important issue, and we're obviously facing a very different type of a downturn now than we've faced ever, frankly, given that it's a public health safety risk. We sort of shut down, locked down the economy for a time in order to keep people safe and get on top of the virus, and then we reopened it. That's come at a tremendous cost to businesses, to disadvantaged sectors that have to work, with end users, travel, hospitality, restaurants, and entertainment, and all of that. So there are many disadvantaged sectors that have really needed relief, and the first CARES Act provided a tremendous amount of relief. The economy's done reasonably well, but now we're starting to feel the effects of those relief programs waning, and we're finding out how resilient the economy really is. I think when it comes to state and local governments, though, they've really been challenged by the fall in tax revenues, and state and local employment is about 10% of all employment if they have to balance budgets. And so I really think that fiscal policy support is important if we're going to avoid widespread employment cuts beyond what we've already seen. And I think that, that's a big part of what the fiscal support would be. So I think it's very important. I think that these are events that, no sector, no group of people, no individuals could insure themselves against. It was a pandemic that nobody expected, and there weren't insurance policies for that. And this is really a natural role for the federal government to step in. As it relates to monetary policy, one reason why we have to do so much and we're at the effective lower bound is when there is not enough aggregate demand, and if fiscal policy doesn't help out. And I think we ran into challenges in 2011 and 2012 and the years beyond that for very similar austerity reasons. And so fiscal support would be unbelievably welcome and effective.
Thanks, Charlie. I agree with you, particularly on the state and local issues. And, you really echo the sentiment of through no fault of their own, which gets me to a second question. I've got a whole line of them coming up, which I'll be asking you from the audience as well. But the Fed specifically inserted, starting in July, in its statement, the sentence, "The path of the recovery will depend significantly on the course of the virus," which to me seems second nature, but it was important for the Fed to do that. Why did the Fed, can you elaborate on what you think it means to have that directly in the statement and really solidifying the Fed's view and on the record, on the official record?
Sure. Well, I think, as I said, this is a downturn. This is a recession, unlike any we've ever experienced before. In trying to put together an outlook and thinking about the path of the economy, we obviously had to figure out whether or not it would be as simple as closing down the economy and then starting it up 3 months later and everybody goes back to their same jobs. Then you realize that there's some industries that can do that. Manufacturing has really excelled at sort of providing safe workspaces. It's controlled. It's not end user related. So I think it's a little bit easier, and it's engineering. They really know how to figure those things out. And there are many examples of that, but there are many areas where that's not possible. And so they continue to be challenged in that regard. Once you start thinking about that, then we just realized there were a whole bunch of different scenarios that we faced. There was the better scenario where a vaccine and therapeutics come online, people feel more confident, we get back to, previous levels before too long. But then there are more adverse scenarios where there's second waves and they're really devastating. And I think because we were constantly saying, well, my baseline is not so bad, but almost equally likely is this second wave scenario. It's very difficult to get that across. And so I think just by saying it's going to depend on the path of the virus, that was really basically what everybody was thinking. And so it was just a sort of a straightforward pronouncement. Now, I will say that I have been surprised that we have continued to recover with the horrific death toll that we have seen in the United States. And about 40,000 cases a day at the moment in the United States. I would have thought if you told me that in June, which of these scenarios were you expecting? I would not have expected we would have seen as strong a growth now as then. We seem to be powering through some horrific personal costs, and we're just going to have to see how that plays out and what the toll will be on consumer confidence going forward.
Thanks, Charlie. I'm going to go start turning to some of the questions in the audience here too. You have been an early advocate. We're an early advocate of inflation, average inflation targeting. one of the questions that came up from another Chicagoan, and I probably shouldn't name everyone, but it's Carl Tannenbaum, who you know. So, but what's your confidence that given the Fed's history on getting to 2% inflation, what's your confidence of really overshooting on inflation going forward?
Well, I think we pretty much embedded that into our strategic framework. And so we've, you know, we're sort of holding ourselves accountable to that. I think we've struggled. I think it's been, you know, just a tremendous achievement what Chairman Bernanke and Vice Chair Yellen were able to do in order to get the long-run framework and the explicit 2% inflation objective adopted back in January 2012. And then we kind of quickly realized that, you know, it really needs to be symmetric. We need to be even-handed about above and below 2%. We sort of struggled with that, and we've learned a lot more about the devastating downward bias of the effective lower bound, whether you're at zero or whether or not it just can come into play, that limits your ability to respond during recessions when you need. And so that holds down inflation expectations too. And so we've really needed to adopt more aggressive communication about the policies that we're going to do. So now we say overshoot. You know, go back through transcripts and not transcripts so much, public speaking, and try to find instances when former Chair Bernanke would use the term overshoot 2%. It was few and far between, and it was usually if you find yourself above 2%, well, you might take a little bit longer to come down to 2 if unemployment is high. It would be like that, as opposed to a purposeful overshoot. And I think that's really, you know, going back to, you know, when Narayana Kocherlakota was on the committee, and, you know, we would both and others sort of say, we need to be in it to win it. We really need to make sure that we've got enough momentum to get to 2% and beyond. So I'm confident that we're going to get to 2% and beyond, but it is right to raise that question. You know, Carl's very good about that. And I was a former colleague with him. I appreciate that greatly.
I know, and I know he was a colleague, and Carl is great. And I'm going over some of the questions here and looking at them, and there's a lot of issues too in terms of if market inflation expectations move up significantly above 2% before the actual inflation moves up, how long before inflation expectations are considered unanchored? So in terms of, you know, having to deal with this sort of line you're walking, and it's an important line to walk between your forecast, like you say, and lags on policy. How much would you take those expectations as a warning?
You know, we're always looking at inflation expectations. The long run framework is quite even-handed in mentioning that, you know, stable, anchored, long run inflation expectations are important for achieving our 2% inflation objective over time. It's also even-handed in saying we need to average 2% in order to support those inflation expectations. I think, you know, I always look at the expectations data. They're always tricky. There's no level inflation expectations data that you can really look at. We sort of look at whether or not they move up or they move down. There's a whole bunch of nuances in all of that. Ultimately, though, you got to get to 2 and you got to get above 2%, or else I'm not going to understand what somebody tells me inflation expectations tell me it's 2.5%, and I haven't seen 2% or whatnot. So we have to actually experience it. But, you know, we've got to put it all together, and we've got to balance the risk. 2.5% inflation does not bother me. I think, you know, if we had momentum beyond 2.5%, I'd like to see that. I'd be, you know, days when we can actually get to something like that would be one where we can, we know how to deal with high inflation. We can raise rates. Dealing with low inflation is much harder because we get to zero so much more quickly. So, I mean, these are some of the things that come to mind, and I just really think we need to get up to 2 and above so that we can average 2%.
And here's another question that's sort of related to that. On the other side of it, you said, you know what to do when you get up to higher inflation, and you know how to deal with that. Certainly in a stronger economy that's overheating with low unemployment, that would be a great sort of warming trend, right? What, though, is your concern that we see some secondary supply shocks out there that could boost inflation? Some of the questions coming in are, you know, that inflation is suppressed now, but we have seen already what's happened in sort of grocery stores related to supply shocks in the food chain as COVID has shut down meat and poultry processing plants and crops have rotted on fields. Are you worried about a worse kind of supply shock that would put the Fed in a bind, or how would the Fed handle that? Do you think that's just not a major risk?
Well, I think those are interesting and important issues to consider, and there certainly are supply components that lead to relative price increases for a number of important goods that can find their ways into aggregate index for inflation, and so it can go up. I think if you look at empirical research of oil price shocks in the 70s and other periods, you can see that inflation goes up, but the role of monetary policy was always viewed as really important. Ben Bernanke, as a Princeton economics professor, had a paper with Mark Watson in the Brookings about it was really the accommodative monetary policy that led to the 70s inflation, that, it wasn't just the oil price increase, but it was the reply of the Fed to that. I'm confident that we are more on top of that, and we would be balancing off what our true inflation intentions were, and whether or not we've been averaging inflation, and whether or not employment was consistent with our maximum employment. We could end up with a situation where unemployment was too high and inflation was a little bit higher, and we'd have to think about what the ultimate consequences were and how persistent that inflation is likely to be. I just haven't seen enough evidence in the United States that these supply shocks lead to persistently high inflation that weren't also associated with pretty bad monetary policy, frankly. And so I think that's the scope of what we need to be looking at.
So you mentioned in the United States, and a lot of the questions that are coming up are whether or not you think there's enough coordinated efforts or communications across central banks in terms of what we're dealing with. This is a global pandemic, and as you mentioned, through no fault of their own, without using the terminology, but this happened globally in scope, like a meteor hitting the earth and sort of knocking us all off of our center of gravity. I think that's important, but do you think there's enough cooperation? Is there more that can be done across country borders, or do you think it's going well in terms of that right now?
I think in terms of central banks, there's a lot of information sharing, just all the communications. We speak in public, other, major central bankers speak in public. They're all the BIS and other meetings where viewpoints are shared. I think we've got a pretty good, in the IMF and the World Bank, I think we've got a pretty good view of the factors that advanced foreign economies, their central banks are looking at. We see their outlooks. There was a time where we were very concerned, obviously, in the spring and early summer, but what they were facing was what we were facing too. And so there was a lot of alignment in that. I think central banks are pretty well aligned. Now, when you add into that what the fiscal responses are, because the fiscal responses are just as important for the total support for the economies. I think if we had, if we had more stable trade negotiations, discussions, so that the uncertainty was greatly reduced. That really was a big, as I mentioned in the speech, I think, from the middle of 2018, I don't think anybody was expecting, anybody to shoot themselves in the foot when you've got a great economy going, and then all of a sudden you layer on top of that uncertainty, which causes business investment to really kind of grind to a halt. And manufacturing was actually in a recession, even though unemployment was very low. So I think, a better sense of a stable policy around the world would be beneficial for everybody getting, out of this. And, it's very important to get our trade relationships aligned and on a fair playing field and all of that. We just need to go about this in a holistic way, I suppose.
Well, I can certainly echo that. And I think we have a lot of people in the audience that would echo that. Certainly the trade uncertainty was a big issue in 2018, as you already pointed out, but it also gets to another issue about how low unemployment was then. And some comments you made that I've heard other people in the Fed make that I've never heard the Fed make. And I was at some of those Fed Listens events, which were amazing, Charlie. But you talked about inclusion, and you talked about full employment in an inclusive way, which is really a different way than the Fed's been talking. I mean, I think it's evolutionary, but it's really different than a lot of people, I think, have understood it in the past. So how will you think about full employment and measuring that shortfall in unemployment as we go forward?
Yeah, that's a great point, and I think it's a real challenge. I think there are many dimensions to the labor market, and you know, the different affected parties and what their employment experiences are. You know, Black unemployment is sometimes mentioned as double white unemployment, and Hispanic is about, you know, the same, very similar. And so there are many disadvantaged groups in terms of their ability to achieve outstanding labor market outcomes. Now, when the Fed comes along and we're looking at how to meet our objectives of maximum employment and price stability, I just think that it's important that we not preemptively impose restrictive conditions without understanding the full implications on the labor market and whether or not success in the labor market is really a signal of rising future inflation. In the 70s, that was the case. We sort of misunderstood that. Hasn't been the case in the last 15, 20 years. I think the Phillips curve has been very flat. And so when we point to shortfalls, I think that allows us a great deal of latitude to drive stronger employment, lower unemployment rates, so that the, you know, disadvantaged groups, it's more inclusive, everybody's getting more on the job experience. That's an investment where they build up skills and they have a chance to, you know, improve their, you know, future outcomes, and more people get to enjoy a middle class lifestyle. I think, you know, the Fed isn't able to deal with income inequality per se because we just move interest rates around. It really requires many other policy levers and, you know, individuals pursuing, you know, better skills and education and the support that helps them do that. Childcare, we're certainly learning in this pandemic environment how important childcare is, and all of the progress that we've made with more female labor force participation being at risk because just the way that the home duties seem to be shared or not shared, it really imposes a larger cost on women. And so just understanding that, and as we think about the costs and we pursue policies and, you know, advocate lightly for, you know, certain types of fiscal policies, I think, you know, that's part of just, you know, sort of smart analysis of how the economy is doing. I mean, that's what NABE does, right? You look at all of these issues around the economy and look at policies that could, you know, help everyone, and, you know, that's really important.
Thank you, Charlie. We're up against our 10:20, our time frame here, or 11:20 on the East Coast, 10:20 here in Chicago, since it is supposed to be in Chicago right now. I want to thank you so much, and especially your comments on inclusion. I know how much you've worked on that with the Fed Listens events, and there's several Feds that are getting together and sharing many of their views coming up. I've retweeted that from the Chicago Fed, I think the Atlanta Fed, the Minneapolis Fed, and is it the Dallas Fed? I'm trying to remember there, but I know the
in
Fed,
Boston, yes, right.
Boston
I mean,
Fed.
all of my colleagues, this is very important to everyone. And, you know, we have a very broad community development area that's also focused on all of these. So yeah.
I appreciate that. And I think a lot of people don't always realize how much the Feds care about, the Federal Reserve district banks care about it as well, and how much of it is executed at your level on a local level. So thank you so much, Charlie, for taking the time and opening up our Chicago conference that's virtual this year. And I really appreciate your comments. I'll turn it back. Thank you.
Thanks, Diane. It's been great.